I'm Greg Hunter. Welcome to USAWatchdog.com. To say the least, the markets have been jumping up and down all over the place for weeks now. And I wanted to have somebody come on and explain what was going on. And I have on Michael Pento from Pento Portfolio Strategies, a money manager and a good one. And you're also a prolific writer. You just wrote a piece about, and in it was this phrase, which I loved, it just stuck on me. That was, they're burning the furniture to heat the house. We're talking about the federal government. Can you explain what's going on? And maybe this will also explain why the markets are jumping all over the place?
Well, you know what an aphorism is. I came up with this reverse aphorism. An aphorism is a saying to live your life by. This is a saying that you should not live your life by. I mean, if you're burning the furniture in your house to heat your house, guess what? You're not too long away from freezing to death, okay? But the government is now selling its assets to try to make the fiscal profligacy look better. We have so much red ink in the government today, and our debt to GDP ratio is now way above 100%, and the budget deficits are way over $1 trillion and going much higher, that the government is forced now to sell assets to try to make it look better. By the way, according to the Government Accounting Office, not from Michael Pento, the GAO, the government has negative equity of over $20 trillion, $20.4 trillion of negative equity. So you take your assets and you minus your liabilities, they're in the red by over $20 trillion. So it's no wonder that this budget deal, which was preposterous beyond belief, it showed that Republicans are just as crazy as Democrats when it comes to spending when they're in power. They're so desperate for money that they're actually draining the strategic petroleum reserve. They're selling 100 million barrels. They're draining that reserve down to 45% of its total. And this is, by the way, why do we have a strategic petroleum reserve? In case there's a nuclear attack. You know, we have Kim Jong-un running around crazy. We have China. These are all threats to the United States. What happens if we had a nuclear attack? We'd have to drain and live off that strategic petroleum reserve. We're taking that down by 45%. And guess how much money, when you do the math on that, it comes to $6 billion. We're so desperate for money from any place that we're actually selling our furniture, our strategic petroleum reserve, to heat our house, to keep the country looking solvent. And by the way, it's doing a miserable job. And like I say in my commentary, unless we were to commandeer all of OPEC nations' oil supplies and sell them immediately, it's not even going to make a dent in our budget. Our budget deficit for fiscal 2019, which starts October, is $1.2 trillion. You add to that the $600 billion bond dumping plan from reverse QE or quantitative tightening from the Federal Reserve. It's $1.8 trillion worth of bonds that are going to be flooding the private market. So the Fed's no longer buying $85 billion a month. The government is selling, and the Fed will be selling to the tune of $1.8 trillion in 1 year. Is it any wonder that we're selling our furniture to heat the house?
People like John Williams at shadowstats.com, and not the one that's going to take over the New York Fed. This is John Williams at shadowstats.com. He says the economy's not doing so hot, that things aren't going as well as they say they are when you look at the real numbers. And does this mean that the Fed is going to keep going with their, 2 or 3 more rate hikes? And they're going to keep dumping bonds, and they're going to raise rates. I mean, the rates are going to have to go up at this. Are they not?
Greg, you're 100% correct. I wrote a book about it once called The Coming Bond Market Collapse. But believe me, I mean, if you look at what these people are saying, that some people are saying the economy's red hot, but if you look at what the Fed, most of the members of the Fed, especially our new chairman, is saying, they are panicked because of what? The Phillips curve. These are Phillips curve academics, and even John Williams, to an extent, is a Phillips curve adherent. So we're worried about now on Friday, we're going to get the non-farm payroll report. So to drop below 4%, to be a 3% handle on the unemployment rate, which of course, according to these Keynesian nut jobs, means that hyperinflation is going to infuse across the entire global economy in a moment's notice. It's never happened before in history. Doesn't make any sense at all economically speaking, but that's what they're worried about. So yes, I believe.
Wait. The Fed is worried about hyperinflation now.
The Fed is worried about, I would say intractable inflation. They are panic stricken, Greg, because they have been schooled in the Phillips curve. This is Janet Yellen had this dashboard of all these economic dials and figures and numbers that we had to panic about. When the economy became so prosperous that people were employed, that would generate runaway inflation automatically, like a light switch goes on. Of course, inflation has zero to do with people being employed. And least of all, the U3 unemployment rate, which is the number of people looking for work as a percentage of the civilian workforce. So, if people dropped out of the labor force, stopped looking for work, the unemployment rate would be zero. And that would be deflationary because the economy would be on the balls of its what. So what you have to understand, and these people will never understand it at the Federal Reserve, is that inflation is about a market's psychology about the purchasing power of its currency. And when the market loses faith in a currency's purchasing power, you get inflation, and it could go hyper. That's coming down the road, I believe, but it's not coming because people are becoming prosperous and working and finding employment.
What in the heck is going on with this crazy time market? I mean, Monday, let's just go back to Monday. We've seen the gyrations up and down. I mean, we're almost 800 points down on a Monday. And somebody comes in and catches that fallen knife to make it look only 450 points. Next day, Tuesday, we're up a couple hundred points. The futures are, wow, happy days are here again. What is going on with this yo-yo, erratic, kooky, can't even explain fundamentally what's going on market? Manarino, my good buddy, says, hey, dude, on Monday, everything sold off. The bond sold off. The dollar sold off. Everything sold off. The stock sold off. Everything sold off. It's kind of weird. Gold went up. What's going on with the markets and gold and silver?
Well, it's got very little, I believe, to do with the VIX or, tech or FANG. Here's the truth. Here's what I believe this early, I believe. So the Fed is on this rate hiking campaign because they're so panicked about the unemployment rate dropping below 4% into the three handles. Even though the economy is pretty weak, if you look at Q1 GDP, it's not even going to be 2%, according to my calculations and many other people that I trust and admire. But even if you look at other more popular metrics from traditional Wall Street, talking about 2.4% on Q1. So the economy is not overheating, and year-over-year earnings growth, which is going to be about 18% or so they believe, from trailing 12 months at the end of this year compared to last year. That's mostly because of this one-time tax cut. That's going to go away. So you have the Fed pretty aggressively raising rates on the short end. You've got quantitative tightening on the long end. They're selling $50 billion per month come October. The yield curve is flattening out. And you say to myself, well, Michael, you wrote a book called The Coming Bond Market Collapse. Well, okay, so the 10-year note went from 1.3% all the way to almost 3%. So that was the U.S. 10-year from 2016 to today. Now it's starting to roll over a little bit. The yield curve is now about 47 beeps wide, which is very, very narrow. That's the narrowest we've been since 2007. But while the Fed's busy raising the short end and the coming recession, which I see happening very soon, is lowering the long end, a funny thing happened along the way to this function is that LIBOR, which people don't understand and very, very seldom talk about, the London Interbank Offered Rate, has been going from 0.3%, so 0.3% at the end of 2015, to 2.3% today.
Wow, it's a huge move.
Okay, now I want to tell you something. The London Interbank Offered Rate is the rate that's applied to, I didn't misspeak, $370 trillion worth of loans and derivatives. Okay, I'm going to say it again because I don't want people, I didn't say B with a billion or M with a million. I said T. $370 trillion worth of derivatives and loans, from credit cards to student loans to auto loans, are priced off of LIBOR. Okay, it's going away in 2021, but this Fed concocted SOFR, SOFR, you can look it up if you want to, but it's not going away until 2021. But here's the thing I want you to understand. The cost of borrowing money, the bond market collapse that I predicted in 2013, started in 2015 and has gone from the most important interest rate, even more important than the Fed funds rate, even more important than the 10-year note, is LIBOR. That rate has gone from 0.3 to 2.3 in the last few years, and it goes up every day, Greg. It's continuing to go up every day. And that is the real reason why the stock market is rolling over, because the cost of borrowing money to buy back your shares is going up very, very sharply. And that's all going away in the fall. All of this is going to hit a crescendo, I believe, in October of 2018, this year.
Your book, which I think is still in print. I don't know if do you still sell this on your website?
I do. Since I've been banned from CNBC and most major mainstream media outlets, a lot less of that book is being sold. But thank God for people like you and people who read that book. You know, I think they're going to save themselves a hell of a lot of money in the long run, because the market's going to drop. The equity averages are going to drop 50% plus in the next debacle. And if they read that book, they'll understand why and save themselves from the third equity market collapse since the year 2000. Go get the.
Well, it's on your website, and I mean, I think I've been dogging you to try to update it. Although you don't have to do much to update it, your predictions are holding. They're true. They're happening. It's happening, just like you said, and it's it doesn't just happen like that until it happens like that. But it's been working just the way you said it would work. And everybody should get the book. I mean, you should buy this book and just read it. It's unbelievable. It's like Nostradamus for the bond market. But anyway, I want to talk a little bit about this. There's a brand new poll out. I'm glad you brought this up. The brand new poll out, 77% of Americans think the mainstream media is fake news. And I have an axiom here. Hey, when you leave stuff out that's too stupid to be stupid to leave out, when you're leaving stuff out, that's fake news. That's a lie by omission.
Omission. Errors by omission, yeah.
Yeah, and you're saying that you got people telling you that, and even Stockman says the same thing. I said, hey, Mr. Stockman, what do people say when you're off? Oh, they agree with me. The host can't agree, but they can't say that on the air. Tell me why you think they're cutting you off the air, because they don't like to hear what you're saying right now. And all the sourcing and the numbers, and they don't like to hear that. Is that why you're being booted? I mean, why do they not want you on? You were a darling of MSNBC and Fox and CNBC and CNBC. Fox Business.
I can tell you what my contacts there tell me, and I can tell you what producer friends I still have there tell me. They say, yes, your ratings are spectacular when you go on. Yes, your predictions have been more right than wrong. Certainly haven't been right about everything. So the audience seems to appreciate me very much. The ratings seem to be fantastic, and they don't want to go into details. They say, but you will not be invited back on. And I really have not pursued the reasons why. I mean, thank God I have people like you, Greg, that invite me on, but I really don't know why. I don't have the answer. Maybe because I talk about things like LIBOR. I mean, you just admitted that you occasionally maybe on mute more than maybe have the closed captioning on in case you have to stare at the screen, but you watch, CNBC. When was the last time you heard the acronym LIBOR mentioned? These people are talking about Spotify going public.
And the fangs.
These people are talking about how important it is. I hear the same people over and over again talking about, I bought more today, but last week you were 100% invested, and the week before you were 100% invested, and you've been invested your entire career 100%. Your cash level's been zero, your equity and bond allocation's been 100% or virtually that level. Yet, so what do you mean you bought more today? You're always bullish. It's always a great opportunity to buy. Go buy some more Tesla, even though he finds it hard to sell 2,000 cars a week. These numbers don't make any sense. The market is going to roll over probably in October.
And that's
CNBC. When someone like me comes on and talks about LIBOR going from less than 1/3 of 1% to well over 2 0.3%, and rising every day. And talk about the derivatives and loans that are attached to LIBOR, and why for, as a matter of anecdote, people with subprime credit ratings can no longer afford to buy a car. Look at the car sales that are coming out for this month. Subprime auto buyers have completely dropped out of the scene. And it's because of LIBOR. It's because car prices are going up, because the cost of leasing or buying that car has gone up substantially. It's one of the reasons why I believe October is going to be crescendo in the market. So, the market is a forecasting, discounting mechanism, usually about 6 to 12 months in advance, and it's starting to roll over now. And you shouldn't be telling yourself, well, it's because Donald Trump is going to go after Jeff Bezos and Amazon because he doesn't like the Washington Post. It's much deeper than that. It's all about the fact that we have a record amount of debt, corporate debt. Corporate debt, by the way, is up 40% since 2008. It's about the household debt. It's at 80% of GDP. It was 39-40% before Nixon broke the gold window in 71. It's about the government debt, which is 105% of GDP. We are saturated in debt. On all the balance sheets are saturated in debt. Debt disabled, I've labeled them. And borrowing costs are surging. Not only just the 10-year, which started to roll off like about a week ago. Don't just look at the 10-year. Look at the short-term borrowing rates. Look at the Fed funds and look at LIBOR. Maybe they didn't want to have someone on me that can talk with numbers and facts and data cogently and make an argument as to why people should maybe not get in this market in 100% invested capacity.
Well, see, that's why people who are investing money, and I don't make any money doing this, and you don't pay me, nobody pays me. I had somebody say, so-and-so paid you for the interview. No, no. I get good people. They talk.
He does not.
They talk about what their book or whatever they do. I mean, that's what I got smart people who know what they're talking about, is what I think. But anyway, this is why.
Hey, Greg, wait, before you leave that, Greg, maybe that's why your ratings are going through the roof.
Well,
because you put people on that actually, you allow them to talk, they make an argument, and, it resonates with a lot of people because they can't get access to certain people anymore.
That's
from
right.
The mainstream financial media.
And if you're investing, $5 million or $1 billion or where you don't want to be candy coated and rah and propagandizing and trained. You want to know what's going on. Is it going to go up? Great, let's buy. Is it going to go down? Gosh, protect me. And I want to talk about protection, the gold market, which is kind of weird. I mean, usually when they have these gyrations, the gold market sells off too. Some people think, well, the gold market's going to sell off just like everything else. But I don't know. I mean, right now, I just had Rob Kirby on. He says in Asia, you can't buy tonnage. He arranges tonnage. He says you might find it in the stores, and if you're finding it, you should buy it. But people who are doing tonnage, I mean, if you got $1 billion to invest, you getting 500 ounces that's nice. That's for my kids' college. But I mean, if you got that kind of money, you need bars. And he says it's short. Why are gold and silver? Are they going to go up if they quit? Manipulating. All the markets are manipulated. But is gold and silver? Do you think you should have gold and silver? Do you think they're going to go up? They went up big Monday.
Well, first of all, they're never going to be stopped being manipulated. The point of the fact is they're going to be manipulated higher, like they were throughout the 2000s and 2008. They're going to be manipulated always. And here's one of the reasons.
And you think? Wait! I just want to get in here with. So you think the manipulation is going to flip on its head? So we're going to go from sticking our thumb on the scale to poop. Sorry.
Yeah, no, of course, because what are the carnival barkers on Wall Street want to do most is make money. They don't really hate gold per se. If gold's going to be in a bull market, and it certainly is going to be in a massive and raging bull market when the Fed admits that they can no longer raise interest rates and the yield curve flattens out and we go into our next recession, oh boy, you better hope you have some position already in your portfolio, because you're going to be paying a lot higher prices for gold and the miners in general. But why is gold so precious anyway? What differentiates it then from fake Bitcoin and cryptocurrencies? Cryptocurrencies aren't gold 2.0. Gold is extremely rare. It's an extremely rare element that is virtually indestructible. That makes it unique pretty much in the universe. Okay, there's not many elements. I think there's 4 elements that never decay. But this element is tangible, portable, divisible, beautiful, very rare, and virtually indestructible. It is money, my friend, and you know this. And that's why it's going to soar in value, and it's going to soar in value despite the fact that some yuppies think that cryptocurrencies are going to supplant precious metals. And when is that going to happen? Why do I think gold's going to prosper? Because I believe gold prospers most when two conditions are extant. One is that the dollar rolls over compared to other fiat currencies. I think that's going to happen. But even more so the case, I believe that real interest rates are going to fall. I believe, really repeat that, real interest rates are going to fall along with nominal rates come October. I think there's going to be a watershed epiphany on the part of the Federal Reserve to understand that they can no longer raise interest rates because the yield curve, which is now only 47 basis points. Now, when I went to school, 25 basis points 2 times is more than 47. So 50 is more than 47. The yield curve is going to flatten out with 2 more rate hikes. We're supposed to have 2 or 3 this year. That's how close we are. Now, that's assuming, by the way, that the 10-year note doesn't start rolling over even harder. It could. What could happen, and what I believe is going to happen, is the yield curve inverts towards the end of this year, the fall towards the end of this year. LIBOR continues to go up because it's a measure of stress. It's an interbank lending rate stress between banks, unsecuritized loans. That is going to continue to rise. And as the economy rolls over and the 18% year-over-year earnings growth is way in the rearview mirror, this economy, which, by the way, in stock market is still 139% of GDP. Its all-time high was 150%, which was reached in January of this year. It has never been 150. It was 149 in March of 2000. The normal ratio, Greg, is 45% of GDP. All through the 70s, all through the 80s, and all through the middle of the 1990s, the total value of equities, the market cap of equities, was 45% on average to the underlying economy. It's now 140%. There is no better metric that illustrates the overvaluation of equities. I like price to sales as well, also at a record high. I don't really look at PE ratios, but if you want to go to PE ratios, trailing 12 is 25 on GAAP earnings, which is extremely, extremely high. But even though that's manipulated because you could issuing debt to buy back stock, which takes the share count out of the equation. So all this is coming to a head in October, and thank you again for having me on to explain to your audience why, don't just listen to CNBC and say, oh, gee, maybe I should buy some more stock because FANG is down a little bit. No. Save your purchasing power. Start accumulating precious metals today.
Well, number one, just to tell you about the economy slowing, General Motors had 20% off sticker. I couldn't believe it. 20, so I just said, so this is the car you have, and it's 20% off the sticker. Yes, that's right. Another dealer was given 25% off the sticker. I said, so you're telling me if I walk in the dealership with X, and that's the car, it's 254359, that's the stock number. You're telling me I can buy that car? Yes, plus the, we have a tax here and a fee here, and that's it. So add $1,300. You're telling me I can buy that car for 25% off, add $1,300. Yes, that's exactly. I couldn't believe it. So they're way hurting.
It's a sign of desperation. But also, I just want to mention this. But so sure. Also, why do I say October? So you've got the ECB is going to cut their QE program in half. Quantitative tightening or reverse QE goes to $50 billion per month. The synchronized global growth recovery pantomime, that mantra goes away because if you already look at PMIs, global PMIs from China, Europe, Japan, and even the United States, they're definitely rolling over. So sequentially, we're rolling over. That, I think, all reaches a crescendo. Oh, by the way, there is also a chance that the Democrats take the House. Look at polling. Democrats could take the House in the midterm elections. That would end Trump's pro-Wall Street agenda. Just cut it right out. All we'd have left is tariffs then. He can't get any more tax cuts passed if that's the case. So all these things seem to be hitting ahead around October. So just be cautious out there. Listen, I manage money for a living successfully. I'm not saying buy 50% gold and 50% short the market. There's a lot of nuance. I have a model that I've created to help me make money for my clients. Most important thing, Greg, I'm preserving principal, making money in a hedged portfolio, and I'm waiting for my model to signal all clear. Right now it's flashing bright amber, bright yellow. It's prepared to go into bright red because of these credit spreads and yield spreads, LIBOR and whatnot. I have 10 components to my model. When that happens, I'm going to go net short the market. I'm all about this, preserving and protecting my clients' principal and making money when this debacle, which is unfortunately inevitable, occurs.
Sometimes, Michael Pento, not losing any money is making money. Sometimes. Even if you don't lose money. I mean, wow, my friends lost 15%. I lost, I gained 0.3%. Anyway.
Exactly right.
Thank you very much, Michael Pento, for being on USA Watchdog. I appreciate it a ton. Thank you so much for being on and coming on, sharing your brain and sharing your strategies. That's Michael Pento with Pento Portfolio Strategies. Also on your website, pentoport.com. You got a bunch of free stuff. And thank you so much for joining us today on USAWatchdog.com.
God bless you, Greg. Happy Passover, happy Easter to you.